Thanks for clicking. The London and St. Thomas Association of Realtors, LSTAR, has released its data for the month of August, showing a real estate market that is continuing to slow down. And the release comes amid new data from StatsCan showing that the Canadian economy actually contracted during the second quarter of this year. And this has led many to argue that the Bank of Canada will indeed be holding at its rate announcement next week.
Well, you've never steered me wrong before.
With that said, as we'll see today, monetary policy might not be so simple. It rarely is. So what I want to do today is go over London's real estate data for the month of August, take a look at the factors the Bank of Canada will be considering when it makes its interest rate announcement on Wednesday, and then discuss the impact on that rate announcement on London's real estate market. As mentioned, the Bank of Canada will be making its interest rate decision on Wednesday, September 6th, and that decision will obviously have a big impact on the real estate market going forward. We will have an update out on that decision on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this data. Onto the data. First up, the benchmark price. The benchmark price, if you'll remember, that's the price of a home, which represents the most popular set of features. The benchmark price in July was sitting at $612,800, and that dropped down about $5,000 to $607,400. So that's a price drop of about $5,000 off our benchmark price in July. The average price, on the other hand, was up, though marginally. The average price in London in July was sitting at $642,693, and that was up about $1,000 to $643,603. So we have the average price up about $1,000 in August. Similar to the benchmark price, however, the median price dropped in August as well. The median price, if you'll remember, that's where half as many homes sell over that price and half as many sell under that price. The median price in July was sitting at $600,000, and that dropped down to $593,000 in August. So we have another $7,000 drop in the median price in London. And the slowdown in London continued when we look at the SLPR, the sales to list price ratio. The SLPR measures by how much over or under asking a home sells. So if a home is listed for $100,000 and sells for $95,000, the SLPR is 95. The SLPR in July was sitting at 100, and that dropped down to 99 in August. That's the first time that London's SLPR was sitting below 100 since April.
Oh, it's a rough life.
So, we have the benchmark and the median prices both falling in August. We have the average price up about $1,000. We have homes selling under asking for the first time since April. However, one of the most interesting parts of the data is the months of inventory, the MOI. The MOI measures if no more inventory came to market, how long would it take for London to completely run out of homes for sale? And the MOI in London was up to 3 months in August, up from the 2.5 that we saw in July. And I say this is one of the most interesting parts of the data, as London really shouldn't have this much inventory going into September. If we look at least the last 5 years, London has never had this month's inventory going into the fall market. With this much inventory heading into the fall market, definitely abnormal for September, we should expect prices to continue to fall further. The interest rate hikes that we've seen over the past few months is obviously having a big effect on the London market, with so much more inventory becoming available. And what the Bank of Canada does at its interest rate announcement coming up on Wednesday will no doubt have a big impact on London's real estate market for the remainder of the year.
And I really need your help. I really do.
And, as mentioned, with Canada's GDP data coming in so much more weaker than most had anticipated, many are predicting that the bank will be holding on interest rates at its announcements. And this was the case even before the release of that data. Prior to the release, 31 of 34 economists had said that the bank will be holding at its announcement on Wednesday. And there's definitely an argument to be made that the Bank of Canada will be holding on rates at its announcement, and not just because of the GDP data. As it was reported at the last read, the Canada's unemployment rate did come in higher for the third straight month in a row. So we have a shrinking economy and rising unemployment, both factors that the Bank of Canada may use to keep rates steady on Wednesday.
Simple as that.
With that said, the economy and the unemployment rate are not the only factors the Bank of Canada considers when it makes its interest rate decisions. Monetary policy is far more complicated than that. The last time that we heard from the Bank of Canada was back in July, when it released its monetary policy report, noting that Canada's inflation rate had become more persistent than the bank had initially thought. Since the release of the monetary policy report, we've seen Canada's inflation data appear to re-accelerate as base effects dissipate. Further, CPI median and CPI trim both have barely budged since that announcement was made in July. And those measures of core inflation, CPI median and CPI trim, are what the bank is looking to when it's making its interest rate policies. Further, at the last policy rate announcement, the last time we heard from the Bank of Canada, the bank stressed that it was concerned with wage growth. And since then, we've learned that wages in Canada are have accelerated to 5%, which is above the current rate of inflation. Definitely not what the bank wanted to see. Also, as the Monetary Policy Report shows, the Bank of Canada has a long memory, and we've seen this before. Right now, Canada's 5-year bond yields are sitting at 3.833, only slightly higher than the 3.57 we had right before the Bank of Canada paused last time. After which, many, you know who, pushed that interest rate cuts were just around the corner. FOMO set in, everyone tried to front run those interest rate cuts, and as we saw, the housing market exploded, and the bank ended up having to raise rates anyway.
The f*** you doing to yourself?
So, while a slowing economy and rising unemployment are definitely what the Bank of Canada was looking for, there are other factors at work. There are other factors at play, which the Bank of Canada has even been explicit that they're looking to when they're making their interest rate announcement. We have wages growing higher than the rate of inflation. We have core measures of inflation barely budging. And we have the Bank of Canada's experience from the last time that they held on rates. Not to mention increasing gas prices, which will no doubt put even more pressure on Canada's inflation rate, not now, but definitely 6, 8, 12 months from now. Now, all of this doesn't mean that the bank is indeed going to raise rates at its announcement on Wednesday. I think this is the most uncertain rate announcement that we've seen in years. What it does mean, though, is that monetary policy isn't as simple as looking at two pieces of economic data. Just looking at the economy and the unemployment rate. There are a lot of other factors at work which the bank has been explicit about. The bank has been explicit that they consider those factors when deciding whether or not to raise rates going forward. And, as such, I think that even if the Bank of Canada does pause, that doesn't necessarily mean that rate cuts are coming to a theater near us anytime soon. In fact, the bank is going to be particularly concerned that any loosening or a perception of loosening, like we saw the last time, could cause inflation to re-accelerate. With all of that said, if the bank does hold off on raising rates on Wednesday, then I would expect to see more demand come to the market. Bond yields are already down, fixed rates are likely to follow soon thereafter, and if the bank signals that they are pausing, we could see more demand hit London's real estate. With that said, if the bank does raise rates and or include some hawkish language in its announcement, then we could see more demand pull back from the market, and as we saw with all of that supply coming to London's real estate market, expect further decreases going forward. We will have an announcement on the Bank of Canada's decision on this channel on Wednesday. Click like and subscribe if you want to get that update, but for now, thanks so much for watching.